Okay, good day, everybody. This is the Option Professor coming to you. It's a very exciting day here in the marketplace. Things that I've been talking about to people have been coming very accurately coming to pass. And so I'll tell you my ideas that I've been sharing with people on not only the stock market, the bond market, the oil market, and the gold market, among others. So you're going to get and of course, the US dollar and the foreign markets. I'm going to be covering a lot of information in 30 minutes. At the end of the broadcast, you'll be able to contact me for more complete details. Obviously, I can only gloss over some subjects right now. Plus, if you have your own stocks, your own ideas that you want to vet through myself and get my ideas, my opinions on what they look like, you'll have an opportunity to check with me and get a free trial on how I operate at the end of the broadcast. Introducing to people who are not familiar with me, the Option Professors, we've been in business in this investment business for decades. We've done we've done hundreds and hundreds of seminars on the options, the uses and risk of options, and we've educated thousands of people. We've traded millions of dollars worth of stocks and thousands of option contracts. So we obviously are experienced and knowledgeable, and we can say we certainly have information that we think will be of value to you. What I'm going to be going over today is some of the indicators I use to figure out when things are going up or down, and I'll go over briefly how options can be used, particularly short-term options, which are very popular now, because if you're on the buy side of those options, the risk is limited, the leverage is there, and if you do catch a volatile move, you can make an awful lot of money on the short-term options. Of course, your risk is you lose the premium, but again, it's different than if you're shorting a market and it goes way up against you or way down if you're long, because you do have the limited risk. I'll get into that in a minute, but again, I'm sharing with you opinions today. I don't know any of your financial circumstances, so these are not recommendations. You get your suitability from your brokerage firm. I'm sharing with you just my views and my opinions. Okay, let's get started without further ado. We've got the S&P 500 today rolling over big time, like 60 points. You know, I've been in this thing for decades. When we get extended, there's going to be a reversion to the mean. It's not maybe, it's not possibly, it is going to happen. The question is when. And of course, I'll show you how we figured out when in this particular case, and you'll get an idea on how we catch these turning points. Also, there's always something that will come up at some point that you're not expecting. How about that the Treasury is going to be issuing way more debt than you ever thought? How about that the Fitch people are going to downgrade U.S. Treasuries? You know, many things can happen. We got a Friday jobs report. Today, ADP said over 300,000 jobs. You know, everyone is saying the Fed is done with their interest rate hikes. What if that's not true? So again, there's a lot of things that can hit the fan. And, you know, this week we also saw China come in with some semi-stimulus that got things going. That's falling apart as we speak. So let's talk right now about how we figured out that the market might be rolling over, as we said on many broadcasts, between 4,600 and 4,675 on the S&P is a zone of selling. And I'll show you how we figured that out. Okay. And of course, hedging. Hedging means you're going to sell calls against your stock, or you're going to sell calls and use that money to buy puts. That's what you do when you're trying to protect your money. Who is telling you different? I don't know. This is my opinion. This is how I would operate. Okay, now let's talk about how we figured it out. You see on the 20-year graph, I look at things at all different time frames. Can you see that how far away we are from the long-term average, like when we hit it back in 2020 during that crash? See, this is why we use these averages, because when you get a big drop, rather than everyone panicking out of their stock, we can tell people that they're running into a support zone here. And in fact, rather than selling all your stocks, you might be loading the wagon. And then once it gets above our other averages, you're back on the bicycle. So these averages have come in very handy to avoid being very excited, like at 4,800, when the averages are way down here. You're going to revert back to the mean, which is exactly what it did. Once it got back above the blue line, which is rising, it's back on the train. Now we're extended again, and that's why we were thinking that the selling area above 4,600 made some sense, particularly short term. Now let's talk about and look at the RSI down here compared to where it was the last time we were up here. That's very low and lagging. So that's not a good thing. Okay, on the 5-year graph, you can see we came right up to the former high of March of 2022, which was 46.31. Guess what the high was here? 46.34. Okay, they nipped you by a couple of points. That's another reason we thought it might be in a sell zone. Again, reversion to the mean is very possible once you get extended. Okay, now let's talk about the 1 year. Okay, the 1 year here. Let's talk about the RSI divergence. You see that high point there? It is at 46.09. Do you see what the RSI is at? 73.88. You see that next new high up here? It goes up at 46.34. Look where your RSI is, 67. That tells me we're running out of gas. That tells me to hit it. You got it? And now go to the monthly graph, because obviously the shorter term you're trading, you use the shorter term graphs, but you want to get the whole picture. And that's why I'm showing you the whole picture. Again, now you have a 1 month graph. Again, you go look at the divergence showing up. We went from 68 to 60, and then we went up to 73, and then we came down to, look at that, 36. Right after 73 was 58. So you got a divergence at that double peak. That's a sell zone. Then you get under the red line, sell zone. Now we go back up and we go to 46.20. Look at the RSI. It's at 58, right? And you can see that it is basically, and 60 is a big number for RSI, because if it gets above 60, 63, it could accelerate to the upside. If it can't, it can be a top. Now look at the red line pointing down. That's your sell signal. And where's your sell signal come in? It comes in at 46.13. That happened when? Yesterday. Okay. And look where we are now. Now we're getting extended on the downside again. But what a nice ride for a day, huh? What a nice ride. And you don't think short-term puts with that expire Friday are not exploding in price? Of course they are. Now, down here, they've already exploded. So you got to be, you don't start initiating positions way down here. This is not an optimum time to be doing it. Again, my guess is that it's possible we'll go up and try to make another rally attempt. Okay. On the 1 year, you broke underneath the number of 45.85. That was a sell signal. But again, the red line's not pointing down. If you notice back here in February, which I think might be a similar area to what we're doing now, because again, you're going to probably come up here maybe and do some work. And then if you start breaking down and get the red line pointing down, then maybe we could get that big correction back towards 4,300. Okay, that's very, very possible between the time frame of what? August, September, and October. But August can be pretty good sometimes. So we could be doing some more backing and filling. But this number up here, 4,600 to 4,675, that's the zone. I don't think it'll get through. And that's why I've been suggesting that anything above 4,600 to 4,675 is a sell zone. And that RSI looks pretty darn weak to me. But again, it is holding here, right? And this is where we might bounce. The low there, the average comes in at 45.35. And look where you are as far as the low. Okay, take a look again. 45.35 and the lows 45.34. Pretty close, right? So there is some support right here. And that's why, again, the smart money that we think we were part of sold up above 4,600. And maybe if you're a short-term trader, you're grabbing some money right now. Nothing wrong with 60 points in your pocket. Am I right? Okay. Now, a lot of the big stocks are going to be announcing tomorrow. And maybe if they come out with good news, that will give us the bounce. There are Amazon and Apple. Now, Apple is really looking at some relatively flat sales numbers. And so it is priced as if it's going to have a big jump in revenues. And if that doesn't happen, it could be problematic for Apple. I'll give you a quick look at Apple so you can see what it looks like on our stuff. And again, we analyze this on every company. So whatever company you got, you can come to me and we can analyze this thing. You get an independent view. I didn't sell you the stock. I don't care if you hold it or you don't hold it. I can give you a nice independent view with 40 years experience and millions of dollars of stock having been bought and sold. So I certainly know how it works. And I also have traded thousands and thousands of options. So I certainly know how they work. I don't know who you're getting information from, but I think I can stand up to just about anybody. Okay, so here you go with Apple. You have a high point here in Apple at 73, at 180. Now we go up to 200 and the RSI is 64. Guess what? That's not good. You know what that means? It's a divergence on RSI, which means this might have been short covering and weak volume. And so it is very susceptible to a drop. So when we see that, we're looking at puts up at 200 and we're looking at short-term puts. And obviously we've already gone down from 198 to 193. So a 1 week option at 195 when it's at 198 probably didn't cost that much. And if it gets bad news tomorrow, it could be a big payday. This thing looks like it wants to revert back to the mean. And look at the RSI here down here. Can you see it is lagging dramatically? Okay, now let's talk to the 5-year. Okay, again, you had a high point here of 73 and now you're at 71 and now it's a little bit of a divergence, not huge. Again, the trend is still up. We're only looking for a pullback here. We're not looking for a total collapse in the thing. Again, everything is up, but it's extended. So a pullback is not off the table. Let's talk about the 1 year. It's starting to roll over a little bit. Again, and there's a little gap there. Maybe if it got good news, it'll try to go back up there again. But I'm looking at RSI at 77, and then I'm looking at RSI at 70, and then I'm looking at RSI at 65. That's not making me feel extremely bullish right now. You got it? And again, it does have downside capability of 175 if the wheels start coming off. A lot of people would be very surprised. You know who'd be very surprised? Everybody who's been buying this thing all year long on this little stairway to heaven. And when and if it rolls over, you think any of these people will take any profits? You think anyone's going to short? And if the buying dries up because they got bad news on something, do you think that the algos are not going to press the bid side? And you think anybody who's a market maker is going to stand in front of huge volume if the news was bad tomorrow? So again, a very interesting setup here as we go in. And again, reversion to the mean does occur. It has not occurred very much, but again, at some point it can. And the 10-year note is starting to take off. This is the cost of money. Now, they just announced they're going to need a ton of treasuries sold, plus the Fed is supposed to be doing QT. So there can be nothing but pressure on the bond market in the months ahead. It's very possible. Now, can you see here that the 10-year note blew out the highs of July, and it is in the process possibly of making a run at the October highs? Do you realize what the stock market was trading at last October? A lot lower than now. And you know what the interest rates are doing? They're getting pretty close to the yields of last October. I would find that very disconcerting if I had a bunch of long stocks without any protection or without any plans of what I was going to do to manage the risk. So I would be careful up here. Again, the market could keep going. It is in an uptrend. It is on momentum. It's got some spotty earnings here, there, and everywhere. There's a lot of big talk about AI and how much revenue that's going to bring to the table. So again, when you're in a momentum market, and it's not trading on fundamentals necessarily, it can go wherever it goes. But I'm saying the further away you go from these moving average doesn't make it less risky. You want to look at one that really has gotten way afar from the averages, and that's called NVDA. Now let's take a look at NVIDIA, which comes and announces their earnings on August 23. Do you think if NVIDIA, for whatever reason, does not come in with gangbuster earnings, there's not vulnerability here? Let's take a look at the stock, and you can see. Now, these are the moving averages on a long-term basis, and there's the stock. Now, if I showed that to a third grader, would he say that's a little bit high, or would he say that looks like a really good, fair price? Okay, and then look at what? And look at the divergence again. You see the RSI here is at 87. You know what it is way up here? It's at 76. That's a divergence. That's a short squeeze. That's a FOMO, whatever you want to call it. Okay, so again, still could go up. We don't know, what anything is going to go for sure. But again, the idea that you're at 85 on RSI and then you're at 84, it is slowing down a little bit. So again, a pullback is all we're talking about here. And again, it's the kind of company that if any announced, they could go to 500. So there's risk to thinking of a pullback. But up here, in this area, when you've got RSI on the daily going up to 72 and 75 and whatever, and now you go down to 63, 64, anything above 470 was a nice place to take a short-term put. And you're getting paid today for sure if you did that, because again, these puts are definitely expanding dramatically. The VIX hit a 12 handle. Okay, 12 handle. Complacency couldn't be bigger, and insurance on puts couldn't be lower there. I mean, a very, very low price. So again, the setup is there for something to surprise the market. And today we got a little surprise, and you get a little bit of a bite on what can happen if there's a surprise. Okay, so again, my suggestion is to, at the end of the broadcast, get a hold of us. Let's talk. Let's go over what things that you hold are looking like. Put it through our prism and see what you're looking at. Because again, we're not tied to one side of the market. We like to follow the trend. The trends have been fantastic, right? But there's a huge gap here too, and gaps are attractors. Okay, and again, you've already broken from 480 down to as low as 430. That's a 50-point drop in a very short time. If this thing ever came out with any news that wasn't fantastic, you realize there's some vulnerability here. So you got to be careful about that. Okay, I showed you the interest rate market. That's the 10-year note. I'm showing you how the stock market looks as far as the S&P is concerned. Again, we are monitoring it. We do think it's a situation where after August, okay, September and October are going to be difficult periods of time. Seasonally, that happens quite often, and the thing is set up for something like that as well. The other thing I heard when there was a question for Jay Powell at the meeting, somebody said, are you concerned about the high increasing of the assets in the stock market? And his response I thought was pretty interesting. The way I understood his response was these things settle back into what's more appropriate. In other words, it sounded to me like his feeling was that the stock market, and I can't put words in his mouth, but the vibe I got is things get out of hand. They're not going to react to asset prices that are way up because sometimes they come back down into line. That's how I interpreted what he said. So again, that made me also think that 4,600 to 4,650, 4,675 area could be a very good sell zone. And so far today, it certainly has been. Again, some things don't go straight down, so you could pop back up. But again, people who hedge their positions by selling calls and buying puts, replace them with calls, call spreads. What does that mean? If you sold out of NVDA because you bought it at 147 like I did, and you sell it out at 480, right? You take an awful lot of money off the table. You put a call spread in at 480 to 580 or whatever you want to put on, and you're taking a portion of that money and you're putting it back in just in case you're wrong and it goes through the roof. Right now, it looks like it's going through the floorboard. So if it ever pulls back and fills that gap, you'll have all that money and you still had a position above the market in case it kept going. That's called a replacement trade. You're trying to reduce your cash risk while staying in the market. Okay, not right for everybody. None of this stuff is right for everybody, but again, that's definitely a legitimate strategy. Okay, let's turn towards some of the other stuff that's been hot. Let's take a look at China real quick. And China, again, big move up because they're supposed to be doing some stimulus, but they're trying to do domestic stimulus, okay? Because they didn't hand out checks like we did. So their consumer doesn't have all that money. Their consumer likes to spend money on real estate, not on stocks. And they are having a lot of trouble with their real estate because 33% of the country, some people say, is vacant. Just imagine, remember how we had that building boom in 08 and everything was being built? And I live here in a state that had a bunch of golf courses being built, and there were weeds all over them. Just imagine that in a country 33% of it supposedly is unoccupied. So again, nothing but problems with the to get that going again. And then they've got that youth unemployment that's going nowhere. So again, there's a lot of problems there too. So anyway, as far as this is concerned, yeah, you're getting a bounce, and yeah, if you stay above 26, that's a good thing. So right now you got a pretty decent line in the sand on FXI. Some people are saying don't go with this one because this is heavily into banks. So what do they suggest? They suggest you go with Baidu, And Baidu today is down, but you can see on a long-term basis there, if it gets above 160, it could fly. So that one looks pretty good if it gets above 160. Then you go over to a company called EDU. That's a big education firm over there. And with all these people unemployed, they might as well get educated on something with technology. And you can see this one looks like it's trying to get going as well. So there's two. And then, of course, you always got Baba. And on Baba, you're looking at a 20-year graph as well. You can see the purple line is coming down. That's not a good thing. So it could have a lot of problems at 120. And again, if it got above 120, and that would be above that point too, then it could fly. So 160 on Baidu, 120 on Baba would really open the gate for this big recovery trade supposedly going to be happening in China. Without those things happening, I would be very careful. Same thing with KWeb. And KWeb again, $35, plenty of resistance. So again, there's clouds above that could hold the thing down. And if she doesn't get it going over there and they don't really solve the real estate problem and they don't get these kids working and they've got other issues going on, again, this could just be a situation where it takes a lot longer for that thing to come back than people think. A lot of people are in love with EM. So let's take a look at EM. This is the emerging market ETF. Again, running right into resistance. So everyone's running right in there at $42, and now it's already at $40. So because I have this thing here in front of me, I know that $42 is not the place to start buying, because why? If it doesn't get through there, it's going to back and fill again. Looking at the 20-year graph on it, again, right at that 42 number. So if we can start trading above 42, then of course that would open the door. So use that number as a pretty good guide on EM. Now you take a look about crude oil. Okay, on crude oil, what are you looking at here? You're looking at, let's look at the 20-year graph, because we've been very, very good on crude oil. You see this area here? We thought it would hold right around the purple line, which comes in between like 65 and 67. So that was a great place to take your shot. We thought it might have some resistance at around 77 to, well, you can see the green line there, somewhere between 78 and 85. There's resistance on the averages. But this thing does look like it might want to make another run. And here you go at the 130 number. If you had a 60% throwback rally, what are you looking at? You're looking at about probably above 100, maybe 110. That would coincide with what I'm going to show you right here. This is the Goldman Sachs Commodity Index, of which we have been very positive on, and I'll show you why. You see, this is called overbought, and there's going to be a reversion to the mean. So we know it's coming back down at some point. There's your RSI at 75. There's your RSI at 67. It's out of gas. It's coming down. Now it comes down towards where the support is. That's called reversion to the mean. So it held nicely around the 525 mark. Once it got above 550, that was our first buy signal. We need to get above 600 to get the second one. And if it gets back up under the blue line here, and clearly right now it's having trouble right at the number of 587. Can you see we're right there? 587 is right where it's trying to hold. See today's low, 587? Very important that it holds there, because if it closes underneath there, then the red line is still dominating the action, and a move down towards 500 is still possible. So that's why the oil going up into 82 and now back underneath 80, it might be telling us that this thing is not going to be able to get through here, and it might go down for a retest. But if you get this thing through here, 600, I think you're going to see the oil pop above 85 and really get moving. And there is a gap on the graph that we saw. Let's see if we can see it here. Yeah, you see this gap up here between 700 and 705, something like this. That could be where it's going. So if it gets moving, there's some real estate up here, and that would probably mean $100 crude, and it could mean very good for the metals, both industrial and precious, and also be very good for the food, which would be your grains and other things like that. Those are the main constituents of this index. So the commodity sector has made a turn, but It is now under pressure because you can see it has run into some resistance right there. And that's why it's stalled out on gold, it's stalled out on oil, and it's stalled out on the grains. Okay, so we have to figure out if that stall is the end of the game. If we start going back down here underneath the the 587, which is the low today, and some of these other numbers like 566, then it would open the door for the 500 support. Okay, but again, it does look, and again, the other thing is the US dollar. Let me show you that real quick here. And everyone was short the dollar, right? A dollar is going to go to hell in a handbasket, 99, and we're already back up here getting back on the bicycle. If it gets above 105, it could maybe make a run up to a 60% throwback. So you got a 15, so that would give you about 108. So it could go up here if it's going to have a 61% throwback. So the dollar right now, if it stays under 105, could resume its downtrend, but you can see it has already reverted to the mean, and that's why the money on the downside is tough to come by, because you're late shorting it, right? Okay, we are pretty much now. Let's see one other thing. Gold. Everyone likes the gold, right? Well, let's see how the gold looks. Gold going under 1950 was not a good thing. But again, the key here is staying above 1830, 1850. That's the big key. But on the 1 year, you can see it's really in trouble unless it gets back above 1960. So if you get it back to 1960, 1980, definitely a train to get on. Right now, looks like a train to be on the sideline and see if this thing's going to fall apart, because it could start accelerating to the downside if it gets any weaker. Getting back above 1950, 1960, very important. You can see the red lines pointing down, comes right in like we talk about, 1950. Big numbers right there. Why hold on to a possible time bomb when you can obviously go to the sideline, see if it gets above 1960, jump on there and have momentum on your side. Okay, this is the Option Professor. I'm wrapping up right now because this is the 30-minute time frame that we were going to give you a market update. Whether you're in the tech sector, whether you're in the industrials, the financials, or any of the different sectors of the stock market, we follow them all. And as far as international, we're right on top of it. Metals, both industrial and precious, right on top of it. And of course, we are on the interest rate market as well as the US dollar. So if you have a portfolio out there, if you are an investor and you'd like to get an opinion from somebody who has not told you to do anything and is not telling you to do anything, but has an independent view, decades of experience and knowledge, can share it with you in a one-on-one type of situation, because I give you my indicators and then we go online and then we do our talk. I didn't have time to go into the short-term option ideas. I got plenty of ideas on that as well. I give you a free trial on this, so there's no risk to you. And I would suggest you take advantage of that. So how do you do it? You contact me, the Option Professor, by going to optionprofessor.com, putting your information in, and we contact you back. Or you can call the office, 702-873-8038. Again, this is Jim, the Option Professor. Look forward to helping you educate yourself. And until next time, have a good luck and good trading. Good day, everybody.